2007. This time, unlike in 1998, the underlying problems lingered and festered. Large numbers of mortgage defaults led to sharp losses at major commercial and investment banks in the United States and Europe. Liquidity in credit markets dried up by the end of 2008, with severe repercussions for the real economies of the United States and Europe. Crises such as those that occurred in 1987, 1998, and 2007-2008 generate innumerable books and government inquiries, and inspire nearly purple prose descriptions in the press. In the 10 years following the most recent global financial crisis, countless authors have attempted to explain its root causes. Why add one more book to the pile? Perhaps because we are not well served by explanations that portray financial crises as either unforeseeable, inexplicable, or unavoidable acts of God, or inherent characteristics of capital markets. According to the University of Chicago professor Eugene F. Fama, one of the earliest and most prominent proponents of the theory that market prices always reflect all available information, changes in underlying fundamentals were behind the steep drop in stock prices on October 19, 1987. The stock market, he wrote, moved with breathtaking quickness to its new equilibrium, reflecting changes in underlying fundamentals, and its performance during this period of hyperactive trading is to be applauded. In 1988, University of California professor Mark E. Rubenstein, co-creator of an investment strategy that came to be known as portfolio insurance, cited 12 fundamental factors that caused the 1987 crash, including increasing interest rates and rising budget deficits, but later concluded that an explanation based totally on fundamentals was inadequate. Journalist Michael Lewis described the 1998 stock market crisis along these lines. Alan Greenspan and Robert Rubin said they had never seen such a crisis, and neither had anyone else. It was one thing for the average stock market investor to panic. It was another for the world's biggest financial firms to panic. The world's financial institutions created a bank run on a huge global scale. Myron S. Scholes, co-creator of the Black-Scholes-Merton option pricing formula and a partner at LTCM, thought maybe part of the blame for the flight to liquidity in August 1998 lies with the International Monetary Fund, which had declined to bail out Russian debt holders. James E. Jimmy Kane, chief executive of Bear Stearns from 1993 until its collapse in 2008, gave the following eulogy for the late, legendary firm. Life goes on. This company achieved lofty heights for sure, but we ran into a hurricane. Richard S. Fuel Jr., former head of the now-defunct Lehman Brothers, looking back on the events of 2008, opined, "It's not just one single thing. It's all those things taken together. I refer to it as the perfect storm." In effect, these crises are viewed by many as perfect storms. But, as scientists are beginning to discover, perfect storms are the result not only of God and nature, but of man. The same holds true for financial storms. For example, a number of flash crashes, sudden sharp and seemingly inexplicable price movements, have been blamed on market manipulation, investor error, and computer trading algorithms responding mechanistically to price changes. Perhaps the best-known incident occurred on May 6, 2010, when the DJIA dropped 1,000 points in a matter of minutes, a decline of roughly 9% from its high point of the day, but quickly recovered. More recently, on February 5, 2018, the DJIA fell 900 points in 15 minutes and ended the day down 1,600.